My name is Rich Preston. I'm a mortgage loan officer, branch manager. I've been in the mortgage industry for a while now. I've been in real estate for even longer than that in some capacity. So I was happy to see that our friends at UWF titled this Navigating the Home Loan Process. And so that navigating word, when I think of navigating, of course, think of ships and thought about cruises. Cruises are something, in my opinion, are similar to the home loan process, going on a cruise. So show of hands, who here has been on a cruise before? Anybody here? Not very many. Who wants to go on a cruise? Anyway, okay, there we go. All right, so yeah, to me, it's very similar. And so maybe you'll learn something about cruises and mortgages as well. Mortgages are boring, so let's try to liven it up a little bit, give you an example of going on a cruise. That's one of my favorite vacations. I love them. I've been on a dozen. That's like the best rest you get on a vacation, in my opinion. So I'll get started here. I'm calling it a journey to your destination. Destination is buying a house. So in the journey, what's the journey look like from the beginning to the end? And that's what we're going to go over here. Let's see, for instance, going on a cruise, there's a beginning point and then there's a destination. So that's the way a mortgage works. There's a beginning point and then there's a goal to get to the end. There's several stages of the process from planning to arriving at your destination. So we're going to go over those stages and highlight some of the major points you'll need to be aware of in getting a mortgage or buying a home. So first of all, we're going to start with an overview of the steps. There's 6 major steps. First, the team, yes, your crew of your ship and what they do, your budget. What kind of voyage can you afford? There's different prices out there. So, you got to determine ahead of time what you can afford to do and what you can afford to pay for, and that'll help you make a decision about the kind of cruise you're going to go on, the kind of house you're going to purchase. So stage 3 is pre-qualification and pre-approval. There's 2 different words there, and we'll go over the differences in those as well. And in that stage, that's where you're choosing your ship, which is your loan type, and your voyage, which is basically how much you're going to spend on a home. Stage 4, offer and contract. Kind of like booking your trip on a cruise. That's where you're signing a piece of paper to buy a house. You put an offer in, you get accepted offer, and that's where you go from there. That's like booking your trip on a cruise. Underwriting, that's the longest part of the process typically. That's where if you're on a cruise ship, you're spending time from the time you leave to the time you get to your destination. You're out at sea. That's where the bulk of the time is going to be. That's where underwriting is. So we'll go over what that looks like. And then closing, once you get to that port, to that destination, you're going to dock that ship and then you're going to get off and then you're done. That's where your destination is. That's where you want to be at the end. So first off is the team. This is your crew of the ship and what they do. So they're going to help you not get on the wrong ship. There's a couple of ships you don't want to get on. So, that's what the captain's job is, which is the loan officer. That's my job, is to make sure you get on the right ship. There's different kinds. There's an FHA ship. There's a VA ship. There's a conventional ship. There's a USDA. There's different types of ships to get you to where you want to be. And so you want to make sure that you don't get on the wrong one. So as far as the crew goes, like I said, the captain of the ship, that's your loan officer. They should be familiar with the path to that destination. They can chart the course to get you there. They should be familiar with those different types of ships that you could possibly take so they can recommend which one's going to be the best option for you. There's tons of other people. Just like a cruise ship, you got a ton of people in the background that are on that ship to make sure it gets to its destination. And that's your other parts of the cruise. These guys you'll see sometimes you won't see these guys. So, but they're working tirelessly in the background to make sure that ship gets to its destination. You may have a real estate agent. That's your realtor that's helping you shop for the house. Loan processor, that's typically the person that handles all that boring paperwork. The title company, that's going to be where you go to sign your documents. They'll also search to make sure that title on that property is clear, and we can get into that later if you need to know more about what that means. Underwriters, that's the guys who review everything, make sure it meets the rules and the guidelines, make sure everything's on the up and up. And then appraisers, that's the guys who make sure the house is worth what it's being sold for. Make sure you don't overpay for the house. Home inspectors, pest control companies. There's a whole crew of people in the background that you don't, maybe you're not aware of, that are helping get you into that home, to making sure things go right, to making sure that house is what it looks like on the outside. So, so that's your crew getting to there. So the second stage of that is your budget, and that's what kind of voyage can you afford? You know, what kind of house can you afford? So there's some things you need to ask yourself there. There's a cost, of course, to purchasing a home. So you need to ask yourself, how much can I afford for a monthly budget, monthly payment? So there's going to be a monthly payment on that house. And what you don't want is to make yourself, to extend yourself beyond what you can afford and get yourself in trouble later. You need to also ask, do I have the funds available for the down payment and closing costs? So there's going to be an amount there that's needed. So you'll need to make sure that you got that part taken care of beforehand. And then other costs. There's other costs that you should consider in owning a home. Home ownership does come with some other costs rather than just your monthly payment. And we'll get into that here in just a minute. So the first thing is your monthly payment. We'll talk about that. So there's 4 main parts of that, and in some case, a couple of other items. So you may have heard the term PITI. That's principal, interest, taxes, and insurance. That's what makes up the primary part of your house payment. You got principal and interest. Taxes, that's your property taxes. So the county, wherever the home's located, they're going to want property taxes for that home. So that's part of your monthly expense. Insurance on the home. You know, you got homeowners insurance. That's going to be part of your monthly expense. Then your mortgage insurance, in some situations you'll have that, some you won't. And I'll expound on that here in just a minute. So that would be possibly an additional monthly amount. And then HOA dues. So anybody here familiar with HOAs? Hey, or your home is currently in an HOA? Yeah, okay. Some of those are good, some of those are not so good. I've heard horror stories about them. Of course, some people love them, some people don't. But HOA, what that means is you'll hear it a lot, especially condos. Some neighborhoods will have HOAs, and that's money that neighborhood is collecting, or that condo unit's collecting to maintain common areas. There's lots of different reasons they collect that. But if you're in one of those properties that's a condo or a house that's in one of those neighborhoods, that's a monthly expense. You know, sometimes those are paid yearly, sometimes those are paid quarterly, sometimes you pay those every single month. But again, that's something else that could be part of a monthly expense you need to take into account. It's not just that PITI. The other part is the down payment. You got to consider that. You know, when you go out shopping for a home, I get a lot of people come to me. They may be well qualified otherwise, but I'm like, all right, well, how much do you have saved for your down payment? I'm like, I don't have anything, nothing. And I'm like, well, you know, there's some programs out there, but you know, you're going to need to have something for a down payment most likely. You're also going to have some closing costs that you need to be considering. Then also, the down payment is a percentage of the purchase price based on that loan type. So whatever kind of ship you're taking, you know, that loan type that you're going to be using, there's different percentages of down payments for each one, and I'll go over that as well. So and that's the job of my job as a loan officer, is to explain to you what those different options look like, the different down payments, if there is one, if there isn't one, and what that looks like, so you can make a decision. So my job is not to say, hey, do this type of loan. My job is to give you options, to say, this is option 1, option 2, option 3, and let you decide which way you want to go that looks the best for you. The third part of the financial side of this is your funds to close and closing costs. I mentioned that just a second ago. So when you go to closing, when you close on the home, of course, if there's a down payment, you have to have that money at closing. If there's other costs that were incurred during the process, that you'll have to pay those at closing as well. That could be things like an appraisal. You know, the home has to be appraised. The appraiser has a fee for that typically. Title company, the company, the place you go, it could be an attorney's office. It's where you go to sign the final papers, the final documents at closing, it shows that you own the home. They have a fee for doing that closing. They also have some other fees as far as insurance, title insurance, those kind of things. And we can go over that later as well. But closing, you pay for your first year of insurance. So whatever your insurance is on the home, you'll have to have that at closing as well. So there's a few different items that you need to budget for at closing, and then you can see there potential future costs. So this is something that people don't take into account sometimes. When you buy a house, you are now the homeowner. So if something breaks, something wears out, you've got to pay for that. And there can be some really major expenses down the road. So if your payment is taking everything you've got and you have nothing left over each month, then all of a sudden your roof needs to be replaced, or it starts leaking, needs to be repaired, your air conditioner goes out. And we know here in Florida, we definitely don't want our air conditioner to go out and not be able to have it fixed right away. So, you gotta plan for those kinds of things. And then storms, we get those. You have storm damage. Even if you have insurance, guess what? There's a deductible on that insurance. So you may have to pay that in order to get the repairs done. So just things to think about other than your monthly payment. Part 3 of that process is pre-qualification and pre-approval. This is where you're choosing your ship, which is your loan type, and your voyage, which is your purchase price. And so as far as pre-qualification and pre-approval, there are several different loan types. Basically the ship you take to get to your destination. We as loan officers, we want to make sure you get on a ship that meets your goals and also make it to its destination. If your FHA is what you need in order to get to that destination and somebody puts you on a conventional ship, you're not going to make it there. You might get down, halfway through the trip and have to turn around. So that's, our job is to make sure that you're qualified to be on that ship. So the 4 primary types, FHA, VA, USDA, and conventional. And I'll expound on those here in just a minute. But FHA is typically your lower interest rates. They usually have good interest rates. Mortgage insurance is in FHA loans, 3.5% down. So a lot of people go FHA if they're needing to borrow a higher dollar amount of, compared to how much income they make. It's a good loan for that type of situation. VA, that's one of my favorite loans. I'm a VA lending specialist, and if someone is eligible for a VA loan, it is usually 100% of the time the way to go. VA loans cover people who are eligible veterans, service members, surviving spouses of veterans. So there's different people that can qualify for a VA loan. And again, that's something your loan officer should be familiar with and make sure that that's available for you if you want to go that route. One of my favorite things about a VA loan is no mortgage insurance. So that makes your payment lower. And the rates are always some of the lowest ones out there as well. That's why if it's available, that's the way we're going to go first, right off the bat. We're going to shoot for a VA loan. USDA, that's for rural areas. So there's a couple of things there. Those rates are really good too. Another benefit of USDA is zero down. No down payment whatsoever on a USDA loan, as long as you meet 2 major criteria. That's where the home is located. It has to be in what's considered a rural area. It's not what you think. It's not out in farmland. It's more of just outside of highly populated areas. And so they actually have a map on their website. You can go in there and look at it, zoom in. You can see what neighborhoods and streets are in a USDA area to see if that home is in a 0% down. The other part of USDA that's really major is how much income the whole household makes. So it's everybody who's going to live in the home, no matter if they're on the mortgage or not. There's a limit to how much money. For instance, I believe Escambia County is around $106,000. So if you have one person in there, that one person can't make over $106,000. You got 2 in there, 2 people can't make over $106,000 combined. And then if you have a grandparent that's living in there getting Social Security, that has to get counted. That's part of it. So, it's about any income coming in the house, no matter what. So something else to be aware of. On conventional, the reason that most people go conventional are 2 things. Conventional loans can be used for investment properties. They can be used for second homes. They can be used to avoid mortgage insurance altogether. If you put in 20% down, then there's no mortgage insurance like there is with FHA or USDA. And that's another thing on FHA, VA, and USDA. Those are for primary residences. There's 3 different ways that you can own a home. It's your primary residence, which means you live in that home a majority of the year. Second way to own a home is a second home, second residence. And that means, you can buy a home somewhere else in the country, somewhere that maybe from where a family is, you go visit it. You have to stay in that home at least 2 weeks a year. That's considered a second home. And those have some benefits as well. And then the third way is investment properties. I think everybody's familiar with investment property. You're buying it to rent it out, something like that. It's for an investment, not for you to live in. And so that's where a conventional loan would come in play. So Each of those, yes, they have their unique advantages. And again, your loan officer is the person to go to with these questions. And I wanted to mention that too. You hear a lot of people go to Google first for questions and try to get an answer. And the problem there, when you don't have somebody who's doing this day in and day out, is you'll get 10 different answers to the same question. And the thing there is because there's a lot of old information when you Google something. You might be reading something that was last year. The mortgage industry changes quickly and often. There would be something that's in place today that wasn't in place last month. So as far as a rule. So you need to work with a loan officer to make sure that you're not missing the boat on those questions and those answers. So 5 key details that are the most important pieces of information in determining how much you can borrow in your qualification. That's the expected loan type. Like I said, FHA, you can typically borrow more with an FHA loan. Your credit score has a huge impact on how much you can borrow because it affects your interest rate. So the higher your score, the lower your interest rate. Your income, of course, is going to be a factor. So how much do you make? And then your debts, your obligations. So you have monthly debts like a car note or a credit card payment. Those types of things come into play as far as how much you can borrow. And then assets. How much money do you have in the bank or in maybe a 401k that you have access to? And the reason that one comes into play 2 different ways is not only you got to show that you have the money for the down payment and closing costs, but sometimes when you're getting up to those higher loan amounts and you're using more of your expected income for a house payment, you're going to need what's called reserves. That means they want to see that when you go to closing and you pay your down payment, your closing costs comes out of your bank account. Do you have something left over? How are you going to make that first house payment if you just spent everything at closing? So, that when you get to that higher amount, that's going to matter if you have some extra money in the bank for reserves. And I'll show you the effect they have on your maximum purchase price here. Let me see. I'll go ahead and mention this while I got this up. The difference between pre-qualification and pre-approval, it boils down to documented verification of your key details. Documented verification. So remember that. You'll hear pre-qualification and pre-approval all over the place. You're like, I'm pre-qualified for this, or I'm pre-approved for this. And so there's a lot of discussion in the industry about, what does that mean? Is pre-qualification, is it worthwhile? Is it going to be only pre-approval? And so let me go back to, I want to show you that form about how those different factors affect your payment. So here's the spreadsheet that I created. It's called affordability calculator. You can find these on the internet as well. I've made one myself because there's some things that I could not find elsewhere. So based on those factors, we can kind of determine how much house you can afford. And what's key is that you are actually, when you get pre-qualified, you're pre-qualified for a monthly payment. You're not pre-qualified, say, for a $300,000 home. You're pre-qualified for a $2,000 a month payment. And so, we have to reverse engineer that. We have to take that monthly payment and say, okay, it's this amount of house, and so that you know what you can go shop for. So pre-qualification, when you contact me and you're wanting to get approved for a loan, in my world, we go ahead and do a credit report because I need your credit score. I need to know what debts are being reported on your credit report, so I have a monthly debt amount. Then you're going to tell me, well, I'm working at so-and-so job. I make, $72,000 a year salary. So I'm all right, I'll plug that number in. And so what we're working towards is like an estimate. So we're going to do a pre-qualification based on what we can tell right off the bat. And that's what a pre-qualification is. It's a starting point. It should be used to get the ball rolling. It shouldn't be used for a final approval to go shopping with, because you don't know. I get a lot of people who tell me they make a certain amount, and then when we get actual pay stubs, they don't make that amount. Or if they own a business, I get a lot of self-employed customers that say, I'm making $100,000 a year, this so-and-so business. Well, let's see your tax returns. Well, you're writing off all these expenses. You're only making $5,000 a year, not $100,000 a year, because you're writing off all of those expenses. So that's what they're going to look at, because the mortgage company is going to say, you have those expenses every year. You're probably going to have them next year and the year after that. So That can affect a lot of people in self-employed. So that's what the main difference between pre-qualification and pre-approval is. Pre-approval, we're going to actually look at those documents. We're going to make sure that you have that money in the bank that you say you have in the bank. We're going to make sure that you're making that amount per month that you say you're making per month. So that's the biggest difference, and that's where we collect things like your W-2s, your bank account statements, your pay stubs, your tax returns, because we're going to analyze all those numbers. And that's what we're supposed to do as a loan officer, is to make sure how much you can actually get qualified before you go shopping for a house. Because the worst thing in the world is to think you can buy a $300,000 house, you go out there, put the offer on the home, and then when we get documents, you can only buy a $200,000 house. So a lot of people are upset. You're upset, the realtors are upset, the seller's upset. A lot of people that get upset when things aren't done all the way. So you can see there's a big difference between pre-qualification and pre-approval. And like I said, it comes down to documented verification of those numbers. And here's where we're getting into a lot of, this is the middle section of this. This is where the most work's done. So your loan officer, your crew, they're working a lot in this section. There's a whole lot that happens right off the bat. And this is getting ready to get onto the ship. You know, you're getting all that documents together, all your paperwork together, you're making a plan, getting your money together. So this is where the bulk of the work comes into play for you and for your loan officer. Actually, it's at the very beginning. So DTI, and I don't want to get into a lot of technical jargon here, a lot of boring stuff. Mortgages are fun, right? So DTI stands for debt to income ratio. You'll see this one a lot. You'll hear this one a lot. This is a big deal. It's the ratio of your income that's being used to pay your debts and ultimately your mortgage payment. So if you make $5,000 a month and your debts on your credit report are $500 a month, what percent of your income is being used for your debts? Right there, 10%. That's your DTI ratio. That's called your front end because it doesn't include the mortgage payment that's going to be on the home. So once you add in that expected mortgage payment, then you have what's called a back end ratio. So in this same instance, this person's got $500 a month in debt. They're going to have a mortgage payment of $1,500. So now their total debts are $2,000. That same $5,000, now they're at a 40% back end ratio. That means 40% of their monthly income is being used to pay that house payment and that debt. And the reason that matters is because the different lending entities, FHA, USDA, VA conventional, they have a maximum amount that you can go up to. Like I said, FHA, their max is 56.99% of your income. I don't recommend that at all. You do not use 57% of your income to pay your debts and your house payment. You will not have anything left over because we're talking about gross income, talking about before taxes. I think if you got some other income that's not being documented, okay, that's fine. But if you have only one source of income and you're using 57% of that, I do not recommend that. That's the maximum they allow. And again, that number does fluctuate based on your specific scenario. If you have less money in the bank or if your credit score is lower, they're not going to let you go up to 56.99. So that's the way that works. USDA, again, they have a limit, 46%. They're a lot more conservative. They're not going to allow you to use more than 46% of your income for your debts and your house payment. And again, that's going to be tough. You're going to have some money in the bank for reserves in order to get up to that high. And that front end ratio matters a lot too. So if you don't have any debts, you have zero debts on your credit report and your back end ratio is 46, that means your front end's also 46. That's not going to happen. They don't want to see that you're using all of that income for just a house payment. And they're like, well, what if they need to buy a car? What if they get a credit card? What if they take on this kind of debt in the future? That's going to put them way over what they're allowed to get. And the whole reason they're doing this is they want to make sure that you can afford that payment going forward. They want to make sure you're not going to run into trouble later on. And that's the whole reason that they have these guidelines, is to make sure you don't get in trouble and lose the home. Your question?
Yeah, I'm just curious. I know it's probably depending on a case-by-case basis, but yeah, you said that 57% was just way too high. Should probably not go there. But what is the ballpark, just a more reasonable number?
I think it's a case-by-case basis. Let me tell you the reason. I usually use a safe number, of 45%, okay? But if you got somebody who's making $30,000 a month and they're using 50% of their income, they still got $15,000 left over. they're doing okay. But if you got somebody that's making $4,000 a month and they're using $2,000 of their money for their debts, they only got $2,000 left, and they still got to pay taxes on that $4,000. So, the maximum DTI ratio, it's a case-by-case basis, really. And again, that's where a budget comes into play. That's why at that first part I said, look at your numbers, see what you can afford. What's going to work with your budget? Make sure you look at all your expenses and to take into account those other things that you're going to have to pay for down the road. So that way you can determine the maximum number that you can afford. Why is a VA loan my favorite? Well, let's put it this way: a VA loan is a benefit for vets and servicemen, and those guys they have provided service to the country, and they get a benefit. They get lots of benefits because of that, because of what they did. And so the VA loan is one of those. It's special circumstances, special situations that they allow a vet in order to get a home loan. First thing is the interest rates. Those are going to be super low compared to some of the other loan types. Second thing is, and this is a big one, is two of them actually, zero down. They don't have to put a down payment on the home. There's no money required to put down as far as a down payment goes. And even though they don't have to put a down payment, they don't have any mortgage insurance. And so what mortgage insurance is it's an insurance that a lender usually requires to guarantee that loan if for some reason it's not paid back. That's what mortgage insurance is. So that's why FHA, they require you to have mortgage insurance. That way if you default on your loan, then that mortgage insurance kicks in, can help protect the lender. VA, the Veterans Administration, the government is basically backing that loan for the vet. That's why they're not required to have mortgage insurance, because it's backed by the VA. The VA is saying, we're vetting for this guy, so we're not going to ask for any mortgage insurance. Yeah.
Is mortgage insurance normally required if your loan to value is 80% or less?
On a conventional mortgage. Yes. So, okay. So again, most of the time. So FHA, you have mortgage insurance for the life of the loan, unless you're putting down 10% or more. People usually go FHA because they only want to put as little as possible down. So they put 3.5. If you put 3.5% down, your mortgage insurance is on there for the life of the loan. It never goes away. If you put 10% down, it's on there for 11 years. So VA never has mortgage insurance. It doesn't have mortgage insurance. Conventionals is what you're thinking about. Conventional mortgage, if you're putting down less than 20%, you're going to have mortgage insurance. And then once you paid off 20% of the value of that home, so when you buy that home, it's worth a certain amount. Once your loan balance gets down to 80% of that amount, then you can call your lender and say, hey, I'm down to 80%, I want to drop mortgage insurance. And then they'll drop the mortgage insurance. At 78%, it's automatic. So it'll do it all by itself. You don't have to contact them or anything. So probably really super close there. And USDA does have mortgage insurance as well. It's again on there for the life of the loan. It decreases over the life of the loan, but it's still there. And it's about half, a little less than half of what FHA mortgage insurance is. So that's another reason I like USDA, is that amount's a lot lower, so interest rate.
What is the average credit score to be considered not good but not bad?
That's going to be a different answer from just about everybody you ask. So let's put it this way. VA loans don't have a minimum credit score. The VA does not say our minimum credit score is this, but the lenders themselves will have a minimum credit score that they will do. So, a lot of times that's 600, 620 on VA loans. Every 20 points is what's considered a different tier. So 600 to 620, 620 to 640, 640 to 660, and so forth. So, credit scores start out in the 300s. They go all the way up to, around 850. And I didn't put this in my slide. I wasn't going to go into, there's so many different details I could cover as far as mortgages go. But, guys, younger crowd, I'll tell you some things about credit scores, mortgages. You've heard of FICO scores, right? And if you go on Credit Karma, which a lot of people do, that score is what's called a Vantage score. It's not even a FICO score. So, and then here's the another part of this that you may not be aware of. There's multiple different FICO scores. So if you look your credit card, if you have one, you may be able to log into their website and they give you a credit score. You may have seen that on a credit card account. Well, look underneath it. It'll tell you what FICO version that is. That's typically FICO version 8, okay, which is used for getting credit cards. It's sometimes used for auto loans, but mortgages use FICO 2, 4, and 5. There's 3 bureaus, Experian, TransUnion, and Equifax. And they use FICO version 2, one of them does. One of them uses FICO version 4, and the other uses FICO version 5. That's why when you pull your credit report from those 3 bureaus, all 3 of those scores are typically different.
Are around the same range, or are they just like completely like different ends of the spectrum?
As far as the Vantage score versus the FICOs, or it could be higher, it could be lower, it could be exactly the same. And it's because those FICO scores, those versions, they weigh things differently. So when you're looking at mortgages, they're typically going to look at stuff that's more in the past. They're going to be looking at more of your history. You know, credit card companies, they're like, what have you done for me lately? They're going to be looking more at, you know, those kind of things, maybe payments on credit cards. You know, so mortgages are going to look at more in depth, is what I believe, which can help in some situations, and it can hurt in some situations. So I'll give you some pointers on credit scores real quick. It's something that we do for our customers is I can pull a credit report and I can go in there and run scenarios. I can say, all right, we're at a 694. What would it take to get me to a 740? And so we plug that in and it tells me, pay this down, pay that off, see if you can get this removed. So there's lots of things there. One of the biggest factors I see is if somebody has credit cards and has them all paid off to zero. That is not as good as having something on one of those cards. And the reason is they want to see you managing debt. They want to see that when that bill comes due, you're paying it on time. If you don't have any balance on your credit card, they have no idea if you're able to pay your bills on time. So if you're wanting to boost in your credit score, you know, put something on a card each month, pay it off when the bill comes in, and go, you know, put something back on it again. It's usually 10% of your available balance is the best. So if you've got a card with a $1,000 limit, keep it under $100. And that's across the range. So if you have 10 cards with 1,000, you know, make sure you're 10% at the max all the way across all of them. So that's one of the biggest ways, or quickest, easiest ways to get your score up. I've seen some of those make a 40 or 50 point difference in some situations, just because maybe their credit's thin is what it's called. They don't have a lot of different types of accounts. Maybe they only have 1 or 2 credit cards. And so that makes a real big difference for them to show that they're managing their debt. So just something to be aware of on the way credit cards are. Yeah.
Are there any advantages to starting, I don't have a credit card yet, but starting working on your credit now than later?
Yes. Yeah, because one of the biggest factors in your credit score is what's called credit age. Okay, so it's a huge factor. I forgot what percentage it is, but credit age. And what that means is if I have one account and I've had it open for 10 years, and that's my only account that's on my credit report, my credit age is 10 years. I go open a brand new card, now I have a 0 in a 10 years. My average credit age is 5 years now. Then I go open another account. Guess what? My average credit age is 3.3 years because it's an average of how long all of your accounts have been opened. And so the longer you have an account open, the better. That's why some people will pay off a loan, like a car loan or something like that. Well, guess what happens when you pay it off? It closes. And so, you know, it's going to happen. But if you have any kind of an account that you can keep open, leave it open. Credit cards especially. If you have a credit card account that's been on your credit report for a while, even if you don't use it, don't close it. Because take advantage of that credit age. You know, just leave it on there as an active card. Sometimes you may have to use it every once in a while because, you know, some creditors will close the card if you're not using it. So, you know, I've had that happen before too. I've had people with a decent credit score and then they had a credit card that they weren't using. That creditor closed that account. So they lost the credit age of that account and they dropped their score some. So, you know, keep that in mind. Your credit age, late payments are a huge, huge deal. Time heals all wounds. You've heard that before. So if you have something happens, you know, you missed a payment or you were late, time. Every time a month goes by that you get farther away from that negative item, the better your score is going to get. So that's another way. You know, we have a lot of people that have some credit issues, and so we work with them. And I've had people that spent 3 years working on their credit, and then they, you know, I've had some people in the 400s get up to almost 700 after 3 years by doing what we told them to do. So again, it's time. You know, you do what you're advised to do and then give some time, you'll get there. You know, I tell a lot of my customers, it's not about a matter of if, it's usually a matter of when.
Whenever you own a lease, are you getting credit reported for every month you pay your rent, or is it not until that lease is done?
Usually the rent's not reported at all to your credit report. It's according to your landlord. Sometimes I've seen some that have reported, but most of the time your rent is not getting reported. Now, where it does come into play is if certain kinds of loans, your rental history will help you get that loan. So we'll reach out to the landlord or the leasing company and get a history of your last 12 payments to make sure that you paid them on time and how much you were paying. And so that helps. So there's a thing called payment shock. So if you're paying, say, $500 a month in rent and you're buying a house that's $2,000 a month, that's a pretty good jump. That's called a payment shock. And so that can be a negative factor, especially in USDA loans. If you're going to have a house payment that's not too far off from what you're paying in rent, then you know that's better. All right, I'll get back to this. If you guys have any questions, just raise your hands, of course. Like I said before, that pre-approval, pre-qualified, you're getting pre-approved for a monthly amount, not a whole mortgage amount, but it turns into a certain mortgage based on that house. You know, the insurance policies can change it, property taxes can change it, the HOA can change it. So just something to be aware of. And then those are factors that go into, I think I might have had this on the screen earlier, but those are some factors that goes into how much you borrow. It's not just about how much money you make, the loan type, again, FHA, VA, USDA, et cetera, interest rate. Your interest rate can also affect how much you can borrow. Higher interest rates means you can borrow less. Your income, homeowners insurance, flood insurance, property taxes, HOA. I think I've covered this one several times already, so debts. So all those factors there, those will go into play into how much you can borrow. Stage 4 is offer and contract. This is where you're basically booking the trip. And you've already planned for which ship you're going to go on. You know where you want to go to. So now it's time to book that trip. So yeah, you know the ship, loan type you want to go on, what kind of voyage, how much you're going to borrow. Your initial documents, those W-2s, pay stubs, tax returns, so forth. They've been sent to the cruise line, which is the underwriter. So you're prepared. You are pre-approved for boarding. You're ready to get on the ship. You've already passed background check or whatever. You know, you're a U.S. citizen. If you're going somewhere specific, then you have a letter that says that you are pre-approved. And so now you can go start home shopping with a realtor. Some realtors will let you go put an offer in on a home without getting that letter. I don't advise it, and it's becoming more prevalent that those realtors won't even show you a house unless you have that letter. So they want to know that, hey, you don't waste my time. If I'm going to go out here and show you this house and the seller has to make sure it's clean and out of the house or, you know, whatever, everybody wants to know that you can follow through. And that's what that letter is all about, is to say, hey, yeah, I've been vetted. I can follow through on this loan if I want to put an offer in on it. And then when you do put the offer in, then, you know, everybody's already aware that you're good. That's what again, the loan officer, I send that letter out to you and to your realtor and say, all right, we've looked at all their stuff. They're good. They can buy that house if they wanted to. And so that with that letter, you're going to have a better shot of getting your offer accepted as well, rather than someone who doesn't have an offer letter. Working with a real estate agent, this is something that, again, it's your choice, absolutely, but I recommend to work with a realtor if you're the buyer specifically, because a lot of people don't know this, but the realtor is paid by the seller. It doesn't cost you anything as the buyer to use a realtor. And I recommend getting your own realtor, and the reason being is because then that realtor doesn't have to think about your side of things and the seller side of things. They're working for just you. They're going to negotiate hard for you. They're going to ask for things for you. You know, the seller can pay some of your closing costs. That's something that happens every once in a while. It's starting to get more prevalent now. Wasn't that way earlier in the year because homes were so hot and there was so much competition. But that's something that your realtor that's working for just you can do if you have one. They can negotiate, you know, who pays for certain things. They can negotiate what's left with the house. So if you see something in the yard or in the house, you're like, I like that, and I really like that, you know. Like a washer and dryer. If it's in the house and you're like, hey, I like that washer and dryer. Can we ask them to leave that? You know, that's what your realtor can do for you. It's all those little things. There's tons of paperwork on the back end that you might not think about that they can take care of for you. They're gonna make your job. They're gonna make it a lot easier for you. They're gonna, you know, let them do that and let them get paid by the seller and take advantage of that as the buyer. So underwriting. This is where this is the cruise and your days at sea. So you're on the ship. You got your offer's been accepted. Your cruise is on the way. You're in there. You're sailing. Did all that work to get started. Now you're on open waters. You get to sit back and relax a little bit. The underwriter's doing their job in the background. The processor's doing their job in the background. Me as the loan officer, we're doing our job in the background because we took care of all that stuff at the very beginning. So now here's where you get to, you know, kind of relax a little bit. So documents have been submitted, purchase agreement. The underwriter's going to look at all those things that I looked at the very beginning just to make sure, you know, they're going to make sure they agree with me or I agree with them or that there wasn't anything missed. And they're going to do a little bit deeper dig on your life, I guess you could say. I consider them like a private investigator. You know, they're going to go look for stuff that might not show up on your credit report. That might not show up on your pay stub. So, you know, they're going to pull public records and see if there's something. Maybe you own a property in North Dakota that wasn't on your credit report because it's paid off. You know, well, guess what? If you own property somewhere else, there's property taxes on that. That's an expense. That's a monthly obligation that needs to be counted. So, you know, you'll have situations like that. So it's just little things like that. That's the underwriter's job is to make sure that your loan meets the guidelines for that loan type. There's a rule book that we all follow for different types of loans, and that's their job is to make sure it meets those rules. You know, like I said in that last sentence right there, it's possible that, you know, we collect all those documents up front, we can get everything that we can think that we might need, and then, you know, something like that, like a public record pops up, and then we're like, okay, we need a copy of that property tax bill. So there could be some other things, but at this point, you know, we should have everything that we need to get started, and we're working on getting other stuff that we need from other people. We've gotten everything we need from you to get started. Once the underwriter looks at that documents and we get what's called an initial approval. So I want to go back real quick. So here, that initial underwriting review, and they're looking for your stuff, and this is where things kind of get quiet in your world. You know, at the beginning you're scrambling, you're finding your W-2s, you're finding your pay stubs, you're finding all those documents. So you're doing a whole lot of things at the very beginning, and then once you turn those over, then it gets quiet. You know, like, hey, you know, what's going on? Is somebody working on my loan? Is it moving along? You know, so this is where communication is key. So who knows that communication is important? You know, but also the second part of that is the way you communicate. It's not just communicating with the person, but how you communicate with. You know, if I have somebody who we get to this point and all of a sudden things didn't quite work out, something popped up, and I've had that happen before, where somebody had a large debt, extremely large debt that wasn't anywhere, and they didn't put it on their application, and then underwriter found it, and all of a sudden, sorry, you can't get into this home. So, you know, it reminds me of a story. One of my favorite ones is, you know, there's two brothers, and we call them Jim and Joe. Jim's going on a 2-week cruise. He's going on a vacation. So he's planning on leaving the country, and he calls his brother Joe, says, hey, Joe, I got a cat at home, and I need somebody to take care of it while I'm gone. And so Joe's like, yeah, sure, I'll take care of Fluffy, no problem at all whatsoever. So Jim takes off, goes on his vacation, gets on the cruise ship, and 2 weeks later he gets back, gets off the ship and calls up Joe and says, hey, Joe, I'm back from my trip, man. How's everything going? Joe says, your cat's dead. And so he's like, what? He said, yeah, man, the cat's dead. Sorry. He's like, well, what happened? He said, well, I went over to the house to feed the cat, opened the door, it ran out in the yard, and then scrambled up a tree, hopped on the roof. He said, I ran out after it, tried to catch it. I put a ladder on the roof. I climbed up there, and when I got up on the roof, you know, the cat saw me and slid off, lost its footing, fell on the ground, and just landed awkwardly. He said, I grabbed the cat. I rushed it to the vet. The vet did everything they could possibly do, and it's just, you know, she didn't make it. Sorry, man. I really hate it. That's what happened there. And he said, wow, my gosh. He said, that's terrible. He said, but man, you can't break the news to me like that. He said, you know, tell me those details. Give me that story. Don't just tell me, hey, man, your cat's dead. And he's like, yeah, I know, lesson learned, I'll do better next time. And he said, well, how's mom? He said, well, mom was on the roof. So, so anyway, so, just the way you break the news to people, let them know, don't just communicate, but communicate in the right way. So we take that one with you. All right. So as far as the initial approval and the underwriter review, there's some tasks that we're given. What's called conditions is what the technical term is. It's a task list. It's a checklist. I'm gonna run through this because I think we're running out of time here. But basically, there's a list of things that we have to check off that the underwriter gives us to do, like getting the appraisal, you choosing your homeowner's insurance from your insurance company that you want to use. Verify employment. Have to reach out to your employer and make sure that you are still employed and that you still make the money that you say you make. Title search from the title company, things like that. So that's a list of things that we have to do. And so the loan officer and the mortgage company will handle 99% of those items. We'll only reach back out to you if there's something that we can't get ourselves. So once we get that task list, that checklist completely done, checked off, all cleared, that means we get the all clear or the clear to close. That's a word that we love in the mortgage industry and your realtors love as well, is clear to close. That means everything has already been reviewed. There's no discrepancies in your income or how much money you got in the bank. All those things have been taken care of. Insurance is handled, the appraisal came back and the house is appraised for enough. So what that means is, compared to a cruise, the cruise terminology, your ship's been cleared to dock. So you're on your way, you're getting to your final destination, you're about to pull into your dock and they say, all right, your ship, it's all good, we reviewed your paperwork, you are clear to dock at your destination. So that's called final approval. And so CTC, clear to close, and closing, this is where you're getting off the ship. You're docking and you're disembarking. You're getting off the ship at your final destination. So not a whole lot left here to do, but some things that you need to be aware of. So, when you're arriving, you know what date it is. Like, hey, I'm getting there to the dock this evening or tomorrow. So that's what we're going to do at this stage, is to set a date where you're going to close on your home. You're going to go sign the documents, take possession of the home. Just a few last details. This is where I've had some people almost mess up. Fortunately, I don't believe I did. Okay, I'll take that back. I do have one. I got a story for this one as well. So there's a couple things that happens at the very end. Even after you get that clear to close and all your documents have been reviewed, they are still going to reach out to your employer. And this has happened on the day of closing sometimes. They're going to call them and say, hey, is so-and-so still working there? Yes. Is he still making this amount of money? And they're like, yes. Still in this role? Yes. And so if you quit your job or change jobs before you sign those papers and they call that employer and something's changed, it's going to go back into underwriting. You're not going to close that day. It's going to delay some things a little bit. Secondly, don't take out any new debts. Don't apply for a new credit card. Don't do anything at the very end, because right at the end, again, they're going to do a soft pull on your credit to see if you went out and incurred any new debt. Because again, you think about it, your approval is based on the debts that you had during the process. So you got a new debt, that could make you disqualified. It could be too much now. So I've had people they've got the clear to close. They go out and get a credit card and buy furniture for the house. $15,000, $20,000, $30,000 for furniture, and they get a new debt that showed up on their credit report. So guess what? The close is delayed. We got to look at that amount of that monthly payment on that new debt to see if that's going to still be okay or not. I mean, you've heard the story, don't pull up to closing in the brand new car. Same situation. I have a lot of people that ask me, hey, I need a new truck, I need a new car. Is it okay? I'm like, no, it is not okay. Do not go buy that new car until after you get the house, because that payment on that new car is going to possibly disqualify you. It will absolutely do that. $100 of a monthly payment is about $15,000 of mortgage. So you think about that. You've got a $300 car payment that you take on. That's about $45,000 in mortgage payment, or a mortgage amount that you can borrow. So it makes a huge difference. So don't take out any new debt until after closing. And my story about that is, I had a gentleman who worked for Amazon, and he was buying a home, nice home, really nice home, and he was higher up in Amazon, making really good money. And we got down to the last week. We were, I believe, 4 days away from closing. And they called Amazon and said, hey, is so-and-so still employed? Nope, He retired. So yeah, no, he no longer works here. So he actually quit is what happened. We found out, they said retired, but we come to find out he actually quit his Amazon job to go start a coffee shop, which he was okay financially, asset-wise, but he just wanted to do something different. He wanted to get out of the corporate world. Well, he didn't close on the home. We had to start the whole loan over, but in his wife's name. Fortunately, his wife had enough income, so we just swapped it to her, but it delayed closing by 2 weeks. So just one of those things, just be aware of that kind of situation. Closing day, here, your loan officer and your closing agent, we're going to reach out to you and let you know what that final amount is you need for closing. All those numbers are balanced. If you paid for anything ahead of time, we've marked that off that you don't have to pay that. You've already taken care of it. We're going to tell you, all right, this is where you sign. This is how you sign. A lot of signings, closings are moving to online. A lot of virtual closings. You can actually do stuff online without having to go to places now or to title companies. I prefer title companies. I think it's more personable. We like seeing everybody. There's some documents that have to be signed in person. So, it's always the best thing in my opinion. Once you send the closing funds and sign those final documents, you take possession. The house is yours. That's it. Once you've signed those documents at closing, they'll hand you the keys and the house is yours. So congratulations. Looking forward to the next cruise. So any questions? Okay, so she asked, is there a time limit? If you pre-qualified for a certain dollar amount, is there a certain amount of time that you have before you have to buy a home? Is that what you're saying? Yeah. So the way that works, your credit reports are good for 120 days. So that's 4 months. So we pull your credit score, credit report. We can use that one for up to 4 months, but the home has to close before that 4 months is up. So once we get to, say, the 90-day mark, need to be prepared for having to pull a new credit report. So if there's any changes, then, we need to kind of get an idea of what those are going to look like. Likewise, guess what changes every month? Your bank account balance. Your pay stubs, are you still working the same amount of hours? So, because we're going to look over your past 30 days of your pay stubs to see what you're making. And then if all of a sudden you're not working as many hours, then, there's potentially, an issue there. So we like to look at documents every 30 days just to make sure nothing's changed. You still got the same amount of money in the bank, still got the same income. If you're already under contract, then those things can go longer. You don't have to have them refreshed every 30 days, as long as we close within a certain amount of time. But yeah.
So you said on the last slide, they will just contact your employer there at the end. What if you're self-employed?
You're self-employed, then for self-employed, you have to do of course your tax returns are going to be a big key, but what you've done so far this year, you have a profit and loss statement. So you're going to use a P&L to say, all right, here's my income, here's my expenses, and that has to go up to a certain point. They usually don't want those to be more than 30 days old. So say we're in November, you'd need a P&L all the way to the end of October. So that's kind of the way self-employment works. I hope that helped, guys. I really do. There's so many more pieces of this, and I really didn't want to get into all the boring stuff. I tried to keep it high level so that you take some information away today that's really going to help you when you get to that point of actually going and buying a house. So, well, thank you guys.